Hi everyone. So today is our seventh lesson for strategic financial management. And today we will be covering ratio analysis. Now, before talking about ratio analysis, we'll just kind of try and understand, uh, what are the statements financial statements that an organization use, because in order to do a ratio analysis you need to obviously take in certain sections from the organization financial statement. So as you can see here, there are five main financial statements that are used by an organization in order to do the ratio analysis. One is the statement of comprehensive income. So what is statement of comprehensive income? It is basically the income statement. So one of the names that I use for statement of comprehensive income is income statement, where you include the income for that particular period and the expenses of particular period in order to identify the profit and the taxation of that particular company. So basically, that is what the statement of comprehensive income is. And then there is statement of financial position. Now, what is the statement of financial position? This is basically a statement which includes like the assets and the liabilities of the company. So this would include the long-term assets and long-term liabilities, as well as the short-term assets as well as the short-term liabilities. So basically in this, a user is able to look into to kind of figure out what are the long-term assets and short-term assets that the company has in order to identify the liquidity of the company or the efficiency of the company. So we'll talk about it more. So moving on, so this financial position, statement of financial position, is also called as uh, sorry, balance sheet. So we call it balance sheet as well. So the other statement that is basically used by an organization or company, statement of changes in equity. So basically in this, what happens is the equity amounts of the organization, like what uh, when it comes to the equity, what are the amounts that are added, or let's say what uh, like what is the additional equity amounts that comes into that particular period, what are the deductions from the equity from that particular period is included, so as to understand, okay, who owns this company? Who has a largest percentage of the company? Or what is the equity amount of the company? So statement of changes of equity is used for that. So then comes in the statement of cash flow. Now, why do you need a statement of cash flow, you would wonder? So basically, statement of cash flow is prepared in order to understand how much cash an organization has in hand or is going to get the particular next month or the month after, or what they had at that particular period of time, or what is in hand as of now. Because when it comes to the statement of comprehensive income or the financial position or equity, all those statements are basically prepared using the concern accruals concept, where the transaction is recorded when that particular transaction happens. So even if the cash does not come into the company because the transaction happened, that particular transaction is being recorded for that particular period. However, that doesn't mean, because an organization has a large profit does not necessarily mean that the particular profit is in cash or something that the organization has in hand. So now when it comes to a company, in order to have proper operations, to have operation that runs without any issue, the company obviously needs cash in hand or cash flows in order to ensure that the operations are efficiently run. So thereafter, statement of cash flows are prepared in order to understand how the company cash flows kind of worked in. Like, so when did the cash flow come in? When did the cash, when was the cash outflows? This was, so these were identified using the statement of cash flow. So the fifth statement is the notes to the financial statement. This is actually considered to be important because hold on. So financial statement. So for what is financial statements used? One of the main thing is for the users to identify, compare, and figure out how the company is doing, right? And however, now if the company, the user is trying to compare between 3, 4, 5 years, or comparing with another company, the company needs to try and understand how are these things calculated if there is a difference. So notes to the financial statement is very important because in that certain sections, when it comes to standards, in standards, they don't like necessarily say, okay, right, this is the only way that you can prepare. There are areas, obviously, where it is said that, certain things need to be included, certain things need not to be included. That is there. However, there are sections in which there is discretion to choose according to what the company feels is suitable. Like when it comes to calculating depreciation, because depreciation can be calculated in different ways. It could be straight line, it could be reducing balance or something like that. So when a company selects a particular method to prepare the financial statements, those will be included in the notes of the financial statement so that the user knows how the amounts or the values came in so that they can take their decisions well. So now when it comes to financial statements, one of the things that we know is financial statements are basically used for what? For the user to compare with the other years and try and see how the company worked. I mean, the progress of the company, or compare it with a competitor, another company, to see, okay, right, in the industry, how is this particular company, how is the situation of the company. However, now, but just having like 5 years of financial statements, do you think a proper analysis can be done for a user to kind of identify, okay, right, this is the whole situation of the company? Like example, let's say you look into 5 years of income and you look at it and say, okay, right, income has increased. Within these 5 years, expenses has reduced. Okay, right. Based on that, obviously, you can do like a basic comparison. But in order to do a proper performance, to do a performance analysis, in order to kind of figure out the performance of the company and figure out how the liquidity of the company, the efficiency of the company, and things of that sort, there should be some method that is being used. So this is where the ratio analysis comes into play. So ratio analysis basically is a quantitative method that is being used by all these organizations in order to figure out the performance of an organization when it comes to liquidity, when it comes to efficiency, and like even the industry situations and things of that sort. So there are certain calculations that are being used to calculate the ratio analysis. And this is what we will be covering today, because it's very important for an organization or the user of organization to be able to properly compare and try and figure out how the organization is performing. Hold on. Oops, sorry. So I'm trying to, yes. So when it comes to the ratio, so now let's see what a ratio is. The ratio generally involves connecting different items from financial statements of an organization in deriving better meaning. For performance comparison purposes, we have to use either historical performance or the industry performance level. Now, ratio. So basically, what is a ratio? This basically has specific ways in which the financial performance or the financial situation of the company is being assessed using different line items or comparison of different line items. However, when it comes to performance comparison, obviously, ratio analysis, the calculation done for 1 year is not sufficient to do a historical performance analysis. So for that, what we will have to do is calculate the same ratio for that particular period. If it's 5 years, you do the comparison or the calculation for 5 years, then you compare between and try and see the performance of that company when it comes to the profitability, the liquidity, the efficiency, the gearing, or the investor valuations as well. So even the industry performance levels can be calculated. How? You can calculate these particular ratios, the profitability, liquidity, gearing, and so forth. You calculate and do the same thing in a competitor and use the same method in order to do the calculation. Because now you will understand, if when we move on with this lesson, you will understand when I say profitability ratio, there are different ways in which we can calculate the profitability. So what we need to do is we need to make sure that if we are doing a particular method in calculating the profitability, the same method is being used in the other company or the competitor. Thereafter, using that, industry performance levels can be calculated, and then there could be like a comparison, and there are also industry benchmarks that are given in for certain profit like ratios. So then it will be easy for any user to understand the company situation as well. So now, as you can see, there are 5 types of common or traditional ratios that are being calculated. These are like methods that are basically used almost all the time. So the first one is called the profitability ratio. Then comes in the liquidity ratio. Then it is the efficiency ratio, or you call it efficiency ratio, you can call it the activity ratio or asset management or turnover ratio. It depends on, based on how it's calculated, the name also changes, or sometimes based on how it happens. Several names are being used here. And then comes in the fourth ratio type is gearing or the leverage ratio. So you can call it gearing ratios or the leverage ratios, where we will be actually talking about the company when it comes to the equity kind of position based compared to the debt. That kind of thing will be calculated here. Thereafter, it is the investor ratio or the valuation ratio. These are basic ratios that are basically calculated by the investor in order to kind of try and understand, okay, right, is this a good investment? So basically what happens is the investor will invest on something which gives in more value, added more value. So before doing an investment, sometimes what an investor would do is they will calculate this sorry, calculate these ratios for several companies and then try and see which has a better ratio in order to understand, okay, right, that the company is performing well, and then try and invest on it. So that's why there is a investor or a valuation ratio here. Thereafter, now we will be moving on to the first section, which is called the profitability ratio. And we will be trying to understand how it works. So, profitability ratio. So basically, hold on. Oh, sorry about that. So profitability ratio. Profitability is basically expressed as a ratio of turnover or the sales, a ratio of assets used to earn the profit. So basically what happens is whatever the profit that is being calculated in the income statement or statement of comprehensive income will be calculated in comparison to sales or the assets. So one method that is being used here would be the gross profit margin. So what here in gross profit margin, what they do is they look at the gross profit amount. As you can see, the gross profit amount will be divided by sales and then multiplied by 100. So with, oops, sorry about that. Hold on. Today I'm having a bit of technical issues. Sorry about that. So gross profit is being calculated in comparison to the sales. So gross profit will be divided by sales and multiplied by 100. So example, you say the gross profit is 50,000 and the sales is 150,000. So what they do is 50,000 will be divided by 150,000 and calculated by, multiplied by 100. So 50 divided 150 would be 3 into 100 would be that it would be 30%. So so gross profit margin will be calculated like that. So, and the net thereafter, the net profit margin will be calculated where the profit before interest and tax, PBIT, will be divided by the sales and multiplied by 100. So different methods will be used. So gross profit margin, where the calculation would be the comparison between the gross profit and the sales. But when it comes to net profit margin, here, the net profit, so the gross profit and net profit, there is a difference. Obviously, there are expenses that come in there, then the net profit is calculated. So therefore, these two ratios will be calculated in order to try and understand how the company is doing when it comes to profitability, whether they have a good profitability. So these two methods will be used. And then there's another way of calculating profitability would be the rate of return ratio, where the return on capital employed or the return on investment will be used. This is also called at ROCE or ROI, where the profit before interest and tax will be divided by the capital employed. So basically, capital employed would basically be the debt plus equity. So that particular amount will be compared based on the profit before interest and tax and multiplied by 100. So, and then there's another way of calculating, which is called return on equity or ROE, where the profit after interest and tax is being compared or divided by the book value of the shareholder funds, which is the state capital plus reserve, and multiplied by 100. And using this, the rate of return ratios will be calculated. So basically, these are mathematical calculations where these particular ratios could be calculated. Thereafter, what an organization can do, or actually the user, basically what the user will probably do is the user will kind of try and figure out, they can calculate the same thing in different periods to try and see whether the profitability, when the profitability ratio increases, that means the profit compared to sales is kind of increasing. Yeah. So that would show a better position. So using the calculation, the historical calculation and the present calculation, a user can make decisions to identify and see how the profitability of the company or the rate of return of the company is. So here, two things can be done. One, a comparison within the period, within time period before, so the ratios compared to the years before, or it could be used to compare with the competitor to try and understand whether the profitability of the company is good in comparison to the other companies, to see whether the organization is doing better than the other competitor companies. And it could be used even using the historical amounts to kind of do a better analysis and try and see how the company is, how the company will be when it comes to the profitability. So thereafter, we will now move it towards the liquidity. So basically, liquidity, there's another name that we basically use here. It is called the solvency ratio, or these ratios will be identifying the solvency level of the company, looking at how much cash and cash equivalent of current assets are available when the current liabilities fall due. So basically, what do we call liquidity? So liquidity is basically what, your ability to kind of pay in something, how much money you have at that particular time, liquid assets or whatever, to, kind of sell quickly and then make it into cash or cash and equivalent. So in this ratio, what is done is the current asset. Now, I said now when it comes to the balance sheet, so when it comes to the balance sheet, I said it had the assets as well as liabilities, right? So when it comes to the balance sheet, I also said the assets will be divided into long-term assets as well as short-term assets. So here, in liquidity ratio, what we do is we look at the short-term assets and short-term liabilities. So what is short-term asset? These are the assets that we can quickly sell and make it into money, so that if there's some issue where your operations need more money, you can sell these particular assets and get in money so that the operations run smoothly. That is the basic idea. Current liabilities are the liabilities that you're supposed to kind of pay, this particular in a short period of time. So you basically, what you do here is you kind of check, do we have enough current assets to cover the current liabilities? Let's say there is a situation that we have to pay the current liability, right? We have to pay in everything. So if that is so, can we do it based on the current assets we have? Is that sufficient? That is what we kind of do in this liquidity ratio. This is what we check here. So in order to do that, there is a main calculation that we do, which is called current ratio, where the current assets are divided by the current liabilities. So basically, if an organization has a current asset, which is, let's say, 100,000, and the current liability is 50,000, what do you think it would mean? So current assets 100,000 and current liabilities 50,000. So without calculating this, if you just look at it, okay, the 50,000 can be covered by the 100,000, right? Okay, because you have more than the current liability. So there'll be 50,000 remaining. So that, what does that show? That shows that the organization's liquid position is good. The liquidity is good. So in order to do that, comparison, okay, something easy, when you look at it, something easy it will be easy to kind of make a decision. However, when it comes to large amounts, then it's very, very important to do these kind of ratios, to kind of do the comparison, especially if you are doing a comparison between a lot of years or even between 2 or 3 companies. So current ratios would be the current assets divided by current liabilities. So if we look at the calculation in the amounts that I said, so the current assets that I mentioned was 100,000, and the current liabilities I mentioned was 50,000. So 100,000 divided by 50,000 would be, what would the answer be? It would be 2, right? When you look at 2, what do you understand with it? So while we calculate this current ratio, there's something that we, that we are being taught. That is, if the current ratio, sorry, if the current ratio is more than 1, then it is the liquidity of the organization is good. That is what is said. Okay. So what do you mean by more than 1? So if we say more than 1, for it to be more than 1, the current asset and the current liabilities have to be equal, don't you think? For it to be 1, if the answer has to be 1, then the current asset 50,000, liabilities also has to be 50,000, then only it will be 1. So if the current assets can cover all the current liabilities, it would be 1, right? So if it's more than that, that means we have more money with us. So we have more money even if you, pay up all the current liabilities, which shows a good position when it comes to the liquidity position of the company. So that's why we say the current ratio. Basically, any amount, if the current ratio is more than 1, it is supposed to be good. Okay, now we'll look into another situation. If the current ratio is 0.5, what does that mean? Sorry, technical issues today. I'm very sorry about it. So, what did I say? So, if the current ratio is 0.5, 0.5, not 1. So, what does that mean? So it would be 0.5 if the current asset amount is less than the current liabilities, isn't it? If it's the other side, like the current assets are 50,000 and if the current liabilities are 100,000, then the current ratio would be 0.5, which would mean that you don't have enough current assets to sell and then cover the current liabilities. Does that show a good liquidity position? No, it does not. So that's what is meant by having a current ratio more than 1 or less than 1, and how it is used for to identify whether the organization is having a good liquidity position or not. Okay, with that, there's another ratio which is calculated, which is called, we also use another ratio, which is, since the inventory is not readily cash convertible. Now we are talking about liquidity, where we are, we are looking at the assets which are more liquid, right? So when it comes to current assets, it also includes inventory. So do you think inventories are something that can be sold in very quickly? Sold in very quickly? No, it's not. Therefore, there's another calculation that is used for liquidity, to calculate liquidity, which is called the quick ratio or the acid test ratio. In here, what happens is the current asset amount is the inventory is actually being reduced from the current assets, then the current liabilities. So it will be divided by the current liability. So here, my calculation, which I talked about, where the current assets was 100,000 and the liabilities was 50,000. So if I say there is, in this 100,000, there is an amount which is inventory. So if I just say, example, if I say the inventory amount from this is 50,000, right? Though what would be the quick asset ratio? So it would be current assets 100,000 minus the inventory, which is 50,000, divided by current liabilities, which is 50,000. So 100 current assets minus inventory 50,000, it will become 50,000, right? The answer would become 50,000. So 50,000 divided by the current liability 50,000 would show a quick asset ratio of 1. To get what I said. So even then, you can see that there we have sufficient amount to pay the current liability. So we can say, even if we, take away the inventory, we have enough money to pay the current liabilities, which shows that the liquid position of the company is very good. So as you can see, there are two specific calculations that are being done for liquidity, which is the current ratio and the quick ratio. Now let's move on to the next ratio. So, okay. Now we will be calculating the working capital cycle ratio or cash operating cycle ratio. So basically, what does working capital mean? Working capital means the amount of current, amount of extra cash you have in order to, which has more cash that we have in order to kind of go through the normal operations of the company. So basically, working capital is the current assets minus current liabilities. so that you will see how much extra current, extra current assets you have when it comes to the working when it comes to the company. So working capital cycle is calculated. As you can see, we will be using this calculation in order to identify the working capital cycle. So here we will basically first have like the average time raw material remains in an inventory. Okay, so basically here what we will look at is we will try and identify, okay, right, when it comes to the raw materials, if we take in raw materials, how many days does the raw materials stay in the company stores? You look at that. I'm sorry. And then the time taken to produce the goods will be taken in, and the time finished goods remain in the inventory after the production, that will be also be added. And then time taken by customers to pay for the goods will be added, and then the period of credit taken from the suppliers, that would be reduced. So this would be used as the cash cycle period. So basically, when it comes to the cash cycle, we have inventory. If it's in form of raw material, so that means we don't have the cash, we just have it for a particular time. And then the time that is taken to produce will also be a cycle included into this particular period, and the time taken for production and how much time it takes for the customers to pay, all this will be added, and the credit period will be deduced to identify the cash cycle as well. When do we get the cash for this particular inventory or the goods that we produce? So here, working capital or cash operating cycle will be calculated this method in order to kind of identify how does the company operations run, or how much time does it take for the cash to come in to the company. So that will show a proper efficient cash cycle, right? And this will be calculated this way, as you can see. So now let's try and understand, more about what is working capital cycle. So if a working capital cycle is longer, it means the organization finds it difficult to make other overhead payment. So as you can see, so I mentioned this is the time it takes for the cash to come into the company again. So obviously, if it's a longer period, that means if there are other payments, it'll take some time for the organization to pay them as well. So longer working capital cycle would mean it'll take more time to pay the overhead payments for the company as well. And also, if the working capital cycle is shorter, cash flows into the company comes faster and can be used to make overhead payments, thus reducing the overall working capital requirement. So if the working capital cycle is shorter, that means, the time, the the cash that is invested in the raw material and the product, and the time it takes for us to get it as cash is shorter. That means we get cash very quickly. That means we are able to make our overhead payments, and so the overall working capital requirements obviously will reduce as well, because we are having more assets in hand. Also, when we come also to compare the industry average with the company, if the working capital is longer than the industry average, we are simply not performing well, obviously. And it means there is a risk for the organization. And if the working capital is shorter than the industry average, that shows that the organization obviously is performing better than the other players in the in the industry as well. Now, we will be moving towards the efficiency ratio or the asset management or turnover ratio. So for that, There are two particular methods that are being used. One is called inventory holding period, where the inventory is being divided by the cost of sales or the purchases. It and multiplied by 365 in order to try and understand how much time it takes for the for the cash to stay as inventory or the inventory holding period. And inventory turnover, then this is inventory holding period is how much time it takes, and inventory turnover is the cost of sales divided by average inventory, which would basically say how many times the inventory has been sold and replaced over a period of time. This is very important because an organization needs to try and understand how much are how many times this particular inventory that we have is sold or replaced every year or in a period of time, to try and understand, do we have a lot of old inventory or raw material with us? Or, how does the operations go? So for manufacturing organization, inventory turnover is a very important kind of ratio. So it depends on the organization, and to other organizations also it will be very important as well. Then there is average collection period, or the days when the receivables are being divided by credit sales and multiplied by 365 days. So receivables are being compared to the credit sales, and average payable period would be the payables which are being compared to credit purchases and multiplied by 365 days. Obviously, if the collection period is as in more, that means it takes more time to receive the particular the payment for us, and a payable period would show how much for the credit patient purchases, how much time we have to pay. So asset turnover is basically sales divided by the total asset less the current liabilities. So basically it will identify how many times the asset of the company has to be used in order to generate sales, and this will be calculated as follows. Now, we will be now moving on to the gearing or leverage ratio, because this is like a set of ratios used by the organization to kind of identify the firm's capital structure, where the debt capital is divided by debt plus equity. So basically the percentage of debt capital out of the total capital employed will be used here in order to try and see how much debt we have compared to the whole equity, to see, okay, right, do we have more equity, do we have more debt? So it will be very important for an organization to decide upon, right, to see, okay, right, our company, is it run based on the shareholders' equity, or done based on a lot of debt? So this is very important for an organization to figure it out. And then there is the debt to equity, where the debt will be divided by equity. This is something similar, where we will figure out the number of times debt is covered by the equity capital. As in to see, okay, right, do we have more equity? If so, how many times of this particular debt can be covered by the equity? It will be calculated, and the organization will kind of try and see that these ratios are properly maintained in order to make sure that the company runs well. Then we will be moving towards something called interest cover. So basically PBIT, or the profit from operations, will be divided by interest payable or the finance, where it would represent the number of times the finance is kind of covered through the profit from the operation. So here profit before interest and tax, or or the profit which we get from the operation will be calculated based on the interest payable to try and understand this. Then we will be moving towards the investor valuation ratio as well, as you can see here. Sorry about that. So investor valuation ratio. So these are basically set of ratios that are being used like by investors to value the company. So basically one is called EPS, or the earnings per share, and the price earnings ratio. So earnings per share is calculated based on the profit distributed to the ordinary share divided by the number of ordinary shares issued. So if PS will be, that is how it will be calculated, where we will try and see, okay, how much profit does each number of share will kind of get. So each share, how much profit is being given for each share. That is what is meant by EPS. And PE, price earning ratio, is the price, market price per share, and how much earnings you get. So investor will basically see, okay, right, how much percentage do we get? How much percentage do we get from the market price of this particular share that we have? Okay, is this a big percentage or a small percentage? So this comparison will be done by investor, and this will determine the investor who come and invest in the organization. So basically, an unquoted company can use a quoted company's P ratio as a proxy company to value their enterprise. So basically, unquoted company will not have a method of valuing. So therefore, P ratio of a proxy company will be used to value their enterprise. So these are methods that are used by actually the investors in order to invest in the company and try and see whether the organization did well, and whether their investment is good. So limitations of the ratio analysis. Now we will need to try and understand that even though we say ratio analysis is very good, and we can calculate a lot of things based on ratio analysis, and this is a qualitative, also quantitative kind of the method, and we can use to compare between different years on different companies, and this will show you, try and understand whether the company is doing well, because it is based on the amount that we get for the based on the financial statements, which are computed depending upon what the how the organization perform. However, there are limitations for this ratio analysis. While this is particularly used for performance management, so we really need to understand what these limitations are. So just give me 1 minute and I will be explaining to you about this limitation. That's very sorry, just give me 1 minute. Hi everyone, so I'm back. So we were talking about the limitation of the ratio analysis. So now ratios. Oops, sorry, I think I was muted. So yeah, so ratios, basically what do they look into? They look into the the amounts that we have in an organization, obviously the like the financial statements and the amounts that are included in the financial statement. These are monetary values based on different concepts, right? Like in financial statements, one of the things that we calculate based upon is the standards and the accruals concept. So they will look into like mathematical values based on different concepts, prepared based on different concepts. So that means there will obviously be certain types of limitations for this ratio analysis. You also need to understand that, right? So one of the things is one of the main ratio limitations is that the ratio do not look at the qualitative factors of a company. Like they do not include the corporate image, the distribution network, the management competency, the computer base and service, the employee morale, the brand name. These things are basically not included when the calculation of the ratio is done. So basically, a company which is well known might have a ratio calculation which is not that good. However, due to things such as the distribution network or the corporate image, the company might be a better investment. So, so basically, not including these qualitative factors is a limitation of ratio analysis. Also, looking at the financial statements based on different concepts, oops, I was muted again. So, so one thing is not looking at the qualitative factors of the company. The second thing is looking at the past performance of the organization, not about the future. So, future is always uncertain and unpredictable. Therefore, just looking at past performance does not necessarily say that the company would do better in future. Therefore, it is a limitation because we are only looking at the past performance in order to calculate this. Also, to use ratios as a performance measurement tool, the past information over a long period of time and information about similar business in the industry has to be obtained, and it is not practical as two companies will not be identical in every sense. Obviously, when you compare between two companies, which is of different size or different experience and different ways, obviously using this particular using as a performance measurement sometimes will have certain limitations as well. Now ratios are basically subjective, right? So an investor should have personal sense of judgment because different judgments can be arrived at looking at ratios from different angles. So it could be looked into based on different angles. So this is a subjective measurement, so it is a limitation. Ratios act as a guide for an investor to take investment decision, but they cannot be used as a definite assertion. So obviously, this is just a guide, right? This will not be the main decision making factor for an organization. And ratios has no standard form, that is, there are no globally acceptable format for presenting and interpreting ratios. This also adds to the fact that ratio analysis is subjective. As I said, it is subjective and there is no globally accepted format. Therefore, you cannot say, okay, right, when you compare two companies, this is that one company is good and one company is not, because there is no acceptable format. So any person could calculate any way they want, and so it cannot be the main method of comparing two companies. And financial statements can be window dress, that is cooking the account to create a positive picture about the company. So if that happens, obviously, then the ratio will also be very good, because the amounts that we look into to calculate the ratios are the amount that we take in from the financial statement. Therefore, if the financial statements are not accurate, that means the ratio analysis will not be accurate as well. So therefore, certain qualitative factors and certain other factors need to be calculated or considered in order to take a proper performance measurement for an organization. So as you can see, ratio analysis is very important because it will help you try and compare things and all that. However, it will also have certain limitations. So let me do a small recap as I always do. So, small recap. So we were talking about the different financial statements and saying what is used that we use this financial statement in order to do all this ratio analysis. So most of them coming used by statement of financial position and statement of comprehensive income. So as you can see, there were 5 different ratios that were calculated. Profitability ratios, most of it came from the income statement. Liquidity ratios also came from the financial statement of financial position or the balance sheet. And efficiency, turnover ratios came in from both, and gearing obviously came in from the the financial position, statement of financial position. And investor and when valuation risk were also done based on the statement of financial position. So using those different ratios were calculated, and I just kind of explained to you, we did not do the calculations here because obviously those are mathematical calculations and you should be able to kind of take the amounts and then calculate and see. And this is level 7 kind of module. So you're supposed to know all these calculations and we are supposed to kind of help you try to think about it and see how it works. So this is what we covered in ratio analysis, and we also did the last bit, which is the limitations, and we try to understand what the limitations are to try and see whether ratio analysis is like the best method in order to do a performance measurement for an organization. So our 7th lesson for strategic financial management has completed. So I will be we will meet again next week, and I hope that you will go through all the content and you try and read more and try and understand and see how these methods, especially ratio analysis, I want you all to kind of read on those and see how the calculations are compared and used by organizations, and see how the application works and how the application does not work, because it's an interesting area kind of to analyze and see. So you could kind of read through some business magazines related to ratio analysis, maybe books, and try and see what you can gain through this particular topic. And I just hope you have a good day. Thank you everyone for listening to me. Sorry, today we had a little bit of, issues, technical issues from my side. I'm extremely sorry for that. And I hope you have a good day. Thank you everyone for listening to me. See you next week. Bye.